folks. Won't keep you waiting any longer. We'll go ahead and get it set off here. I'm Zan from the Israel Economic Mission to the West Coast. We'll go ahead and get the next slide up with our agenda for the day. And I'll give you a quick overview of how it'll go, and then we'll jump into it. I will mention that the presentation is being recorded, which is useful. You can also find this then on our YouTube channel afterwards. We'll make sure to send it out. But as far as today goes, I'll start with a quick overview of our org if you haven't worked with us before. Go into the kind of larger accelerator program behind some of this webinar series. Actually, if we can go back one more, I'll just give a little bit more on the, so we got an accelerator program that Jim and Ben can go over. Then we'll jump into the presentation with Jim. And then as far as questions, you can actually ask them as we go into the chat box. If Tim's able to respond while we're going, honestly, that's kind of ideal. But as well, we'll have some time at the end for questions if you want to just save them up. Also, we can unmute folks at the end if you want to ask any questions kind of over the voice. And we should have a good, at least 10 minutes to have a discussion at the end about that. So I'll get going with a quick intro of our org. So yeah, so we're the Israel Economic Mission to the West Coast. You know, there is to the East Coast. We're actually one of 45 offices around the world as part of the Israeli Ministry of Economy, helping to connect kind of a direct government effort to connect Israeli companies with strategic partners and investors around the world. And so we work helping pretty much all sizes and types of Israeli companies. There is an honest focus on the tech startup ecosystem, kind of the super strength here of Israel. And this is across all verticals from cybersecurity to automotive, and obviously most importantly, healthcare. And so this is, I think what we're doing here today is a part of one of the many things that we do, right, is providing introductions and virtual connections to these strategic partners, to these investors at trade shows. We look forward to, at some point, to getting back to in-person conferences and trade shows where we can make those actual in-person connections between the startups that we work with and the kind of relevant contacts and parties on the West Coast. But I think this kind of in this time with everything virtual is really useful actually to get some more of the preparation and education across that makes those opportunities a little bit more likely for success, which I guess leads us to part of this program, which is, you know, we'll hear a little bit more about kind of an accelerator program behind it, but really excited for this webinar session is part of a larger series in partnership with the Innosphere, in partnership with CSSI, about really preparing, you know, the startups, focusing on healthcare startups for the greatest success you can have in the US market. So I'll actually pass it over now to Jim for the next piece on CSSI, I believe.
Yes, thank you, Zan. And we're really happy and honored to work with the Israeli Economic Mission to really support companies in Israel who would like to enter the US with their regulated medical device and/or drug or biologic. The goal of this program, as Zan has indicated, is to ensure a seamless and expedited pathway for successful US market entry and commercialization of drugs and medical devices. To that end, we've worked with Zan and his team to establish a group of services that are available to companies in order to access the US marketplace. The various services range from regulatory consultation, access to domain subject matter experts, various educational programs and investor forums, such as the program that's being conducted today. And we've also established an FDA help desk where you can have your questions answered, and there's no cost for this service. And then we also have available a very large network of clinical sites where companies can access. So we're really excited to provide these services in collaboration with the Israeli Economic Mission. Next slide. Just a little bit about CSSI Life Sciences. We were founded in 2005 as an innovative CRO that works with startup and emerging biopharma companies and medical device companies to rapidly accelerate their discovery to commercialization. And as illustrated here, we have a lot of success in helping to advance novel technologies through the FDA by decreasing the risk, the time, and the cost to successful commercialization. We also have available an on-demand drug and medical device project team to help support those companies from Israel who want to enter the US. And with this introduction, it's my pleasure to turn the program over to Tim Jones from the Innosphere, who will review the services that the Innosphere provides, as well as to lead today's discussion. Tim?
Thanks, Jim. Thanks, Zan. Appreciate the introduction. I'm Tim Jones with Innosphere Ventures out of Colorado. We'll start with just a little bit of an overview of what Innosphere Ventures is, and then really jump into a lot of detail around how to ensure that you're ready to raise capital. So Innosphere Ventures, it's been a incubator for over 22 years. Located physically in Fort Collins, Colorado, but we do have branches in Denver, Boulder, South Denver, basically up and down what we call the Front Range here in Colorado. We work with early stage startups and have really taking them through from MVP to commercialization. The incubator itself is a nonprofit that supports these organizations through a lot of networks to municipalities and local life sciences companies, health hospitals, etc. So that's one of the branches of Innosphere Ventures. Another branch is really around venture capital. And as a part of that, Innosphere is a general partner in 2 venture capital funds, one of which invests in Colorado startup companies, and the second is a fund that invests in early stage Israeli companies, and then we work with those folks to help commercialize their technology here in the U.S. And the last part of it is we do have a facility that offers office space and also wet lab space here in Fort Collins. So an overview of what we're going to be talking about here over the next half hour or so is really around raising capital. And so what we'll do is we'll start out by setting the stage, looking at a little bit of data. What does venture capital in the U.S. and how is it distributed? Then we'll move on to a little bit around the types of investors that you may see over the course of your journey, and then a little bit around what does diligence look like by some of these potential investors, and then we'll wrap it with a little bit around how do investors really make that investment decision. So getting started here, CB Insights released a article in November of last year that really touched on why companies fail in the venture startup world. And they went through a postmortem on over 100 different companies, and these were the areas that they determined as to why a company fails early on in the journey. The first one really is around the no market need, and that's pretty critical, right? Of why or what product or what service are you attempting to bring to the market, and really what problem are you trying to tackle? Instead of just having a cool technology or a cool service, it really has to serve a purpose in the market space. And so that's generally known as product market fit. And so you'll see here that really is the top reason why companies reported that they failed. They really didn't understand the market. They didn't understand the market need, and they weren't able to really service that problem in the market space. The second one is around cash, and that's what we're going to be talking about here today. And so when you think about certainly cash and the other resources that startup companies have, they're pretty precious and they have to be allocated very carefully. So running out of money is a big deal. And what you also find, I think, is that this running out of cash is probably tied very closely to other problems. If you were to think about no market need, that meaning, you can't gain traction in the marketplace, clearly you're not going to have customers, you're not going to have any revenue coming in, so you're running out of cash. The third bullet is really around the team, right? And as you build up a startup company, understanding the right skills that the team members need to have at that particular point in the journey in the company is critical. Investors are going to look at this and say, boy, you need somebody with a background in whatever that happens to be, or you need a certain set of skills on the team. But bottom line is, that's an area that startups have identified to say, boy, this is a part where it is a potential problem, and if we don't have, for instance, a strong commercial representative on the team, we're all technical, maybe we're not able to gain that traction that's necessary in the market space. The next one certainly is around what the competition looks like. Investors in particular will think of you as founders as experts in your particular area, and they'll want to be confident that you understand who else is out there trying to save or solve the same problem that you're trying to solve. And so understanding what other folks are doing in the market is pretty critical. That said, you need to make sure that you don't spend your entire time focused on what other people are doing, and you're doing to the best of your ability to solve that particular problem. But having an understanding out there is critical. And then the last one really is around being able to price appropriately. How do you make sure that you're generating enough revenue to cover your costs while pricing so that the marketplace adopts your particular solution? That's not easy in a well-established company. I think it's pretty challenging in a startup environment also. So moving on to, as you think about fundraising, and certainly, in the context of what we had just talked about, why companies fail, understanding some of what we consider to be the bigger questions, right? Around, now I've taken my deal to the marketplace, who is going to be interested in that? Venture capital firms have different investment theses. So maybe they invest in the Internet of Things, IoT. And so if you're taking a med device to, an IoT venture capital firm, there may be a disconnect there, and you may not find, anybody is really interested in what you're trying to, the problem you're trying to solve. The next, step is really finding those investors. How do you find those investors? Whether they're, angels or early stage VCs or later stage VCs, what are the tools, what are the techniques that you're able to use and leverage to be able to find potential investors? Thinking about what your capital strategy is and how much money you'll need. Certainly investors are going to dig into that. And, some investors have theses around capital light strategies. And so if you're going to go off and need to raise $100 million, they may not be interested. But understanding how your capital strategy plays in with your pro forma, with your growth projections, et cetera, is pretty critical, so that as you go out and raise, you raise appropriately. Moving on through some of the compelling investment alternatives. So as a venture capital fund, we're not only looking at potential investments in a single company, but who else is out there and what are they doing? I would tell you this morning, we're looking at a pipeline review for some of the Israeli companies that we're interested in, and we have 3 companies that we would look at and say they're doing the exact same thing. So we find the technology interesting, we find the space interesting, high level we find the teams interesting. The real question is, are we going to invest in all 3? Not likely. We'll probably pick one out of the 3. And so it's a competition effectively for our dollars in this particular instance. One of the key things is around, hey, after you've actually raised that money, what are you going to do with it, right? What milestones are you going to achieve? How are you going to increase the company valuation? And then finally, deal structure and the terms, understanding what those looks like, what are attractive to certain sets of investors, how does it make sure that that you're protected as a founder so that you're getting a good deal, putting together that entire equity look, not only for investors but also for founders, is pretty critical. So as a VC, we look at the risks associated with early stage startups, and we try to really understand and dig into around where those potential risks are coming from, and then what can we do to mitigate those risks. And so here's a general framework around arguably some of the biggest buckets of where we see risks in a certain company. Typically an early stage startup, you would look and say, boy, technology is probably the initial immediate risk. And and can you build that particular technology, that product, that solution so that so that it works. You think about 510K clearances, you think about product designs, the freezes, all of these different milestones are really driven towards a lot of the technology. And so in early stage, that's probably the risk. Now, as you grow, the risk may shift a little bit. Are you attracting the right people to your team? Do you have the right finance representative or the right business development person? So as you go through and as you think about raising funds, whatever stage you happen to be at, the investors may look at your company and identify risks associated with these particular buckets, and may focus on one or two of those by saying, hey, at this stage you should be here, and maybe you're not, and we see it's a larger risk, and so then either an investment will not occur, or they'll make some adjustments to the terms to be able to still try to recoup whatever the reward is at the end as far as the exit. So the big takeaway, I think, from this slide for folks that are going off and pitching for investments is really to understand what are the risks surrounding your particular company and have a very good idea of what those are. And then when you're pitching to potential investors, is to go off and really address those with your investors. So you're bringing that to the forefront, you're having the conversation about that, and you're making potential investors feel comfortable about what that risk could potentially be. So I mentioned, a little bit around what or who are those investors. Here's a slide that effectively builds out, who the investments are, going from very early stage, which you would see is, the founding team, whether it's family, founders, friends, making an investment, all the way up to at the top of the stack, you might see corporate venture capital come in. So the idea is here that as you grow your business and as you grow your company, you're thinking about who the appropriate investor layer is. And so very early on, you're probably raising from your family and friends, and maybe investing yourself to to get the company going, to get it off the ground. Very hard to raise money on just an idea from professional investors. So if you do need money at that point, it's usually family and friends. As you move up the stack, you get to more of the angel type investors, whether they're individuals or groups. They're folks that are comfortable with this very early stage risk associated with companies in this particular layer, and so they're willing to put together a portfolio with the idea that maybe they'll have outsized returns from one or two of the investments, and the rest may not make it. And so you continue up, right? So as you go up, you may get to family offices, you may get to micro VCs, continuing on, and you grow in size and even larger. You get to private equity, venture capital, and then ultimately up to the CVC or corporate venture capital. Some of the key parts around, moving up this stack really is around addressing, the risk of the company. So at the bottom, there is a lot of risk and probably a lot of unknown risk associated with the business. And so as you continue to address those risks, as you continue to grow, as you continue to prove out your business model, your technology, and build your team, the risk level goes down. So what does that result in? Higher valuations, larger investments, and then ultimately, larger investments lead to greater dilution on your cap table. But the point is here that you need to determine where the appropriate stage is of your particular company and make sure you're focusing on those particular investors that are interested in deals in that stage that you're at. So that's kind of a background of what raising looks like here. Moving on to a little bit of the data. Our belief, at the incubator is really, as you go out and have determined that you're going to raise funds, having a base level knowledge of what the market is doing is probably very useful for you when you're having the conversations with potential investors. And then you can tailor your offering based on what that broader ecosystem looks like. So, this is a graph of what has happened, over the past 10 years in the venture capital community. You can see that, your amount of money going into venture capital is, pretty well, swung upwards year over year. Number of deals has gone up, but high level, there's a bit of a dip there in 2016. The early numbers out for 2020. I've seen some very preliminary numbers in for first half of 2020, for instance. Number of deals have gone down, and but actually the deal value has remained pretty strong. And so we can talk about that more later if you want to. But my takeaway here is that between 2015 and 2019, let's say the number of deals have remained about constant, whereas deal value has increased. So looking at that, the takeaway is that there are larger deals being done in recent history than there were in earlier history. So what does that landscape mean to you as you're raising? Well, it kind of depends on where you're at. So the purpose of this slide then is to break out, okay, where is that venture capital money and where are those deals being done? And so you can see here that the angel and seed investments, which is this dark blue down here, certainly is increasing, but it's not increasing nearly as much as you see in the lighter blue stacks, where where you have the early venture capital or later stage venture capital investments. So it arguably the later stage VCs are going to be bigger rounds. So you see this play out here that although you may see, venture capital is a hot space to be in, and there's enough venture capital, there's enough money to go around for everybody. That may be true, but it depends a little bit upon where your stage is at and what sort of capital you're trying to raise. Because if you're in the angel and seed stage, yeah, there's still some there, but it may not be growing as as fast as the rest of the market. Continuing on here, so looking at the more of a activity by deal size, right? When we think about angel and seed deals, those are certainly types of investors, but traditionally they've been maybe 500K, maybe $1 million round. Looking at this graph, you'll see that there's a lot of growth here in that $5 to $10 million range over the last few years, right? And so this is all angel and seed data. So there's a lot of larger rounds that angels and potentially micro VCs are leading, which is kind of interesting. The other point I think to take away here is that if you're thinking about raising $25 million plus, there are very few rounds that are being led by angels and micro VCs in that type of raise. So again, trying to think back, you as a founder, you as a business leader, where are you going to go to get money? If from an Innosphere standpoint, we would not coach folks to if they want to raise $25 million to look to local angels to raise that kind of cash. It's just an outlayer. So you might want to go a different direction and look for different type of people to be able to raise those particular rounds. And so that's a little bit more on the angel and seed is really around we talked here about where our folks, where our angels really focused. You see that they're entirely focused on $5 million and less rounds. So so just be aware of that, right, as you're thinking about who you need to raise from. The other concept here that I wanted to introduce was really as you go through the rounds, right? As you go through your friends and family, you go through your pre-seed, seed round, Series A, B, C, etc. There's always a step up in valuation, and what I mean by that is, so maybe you raise on a $5 million pre-money valuation for this round, and that may be appropriate to raise $500,000 or $1 million from a set of angels. You have to take that money, you have to meet some certain milestones, and you have to then increase your valuation for the next round that you go out for, whether that's a seed round or Series A, etc. And that's really what this graph is showing. So you see here, right, early VC, the dark blue. So I'm going to focus on that one more than the green one. The dark blue bar graphs. As you go from round to round, you see somewhere on the order of about 1.8 multiplier for your increase in valuation, and that's pretty key to you as you think about what your overall capital strategy is going to be, because without increasing valuation between rounds, and you're trying to raise more money, you're really going to wind up severely diluting your ownership in your particular company. And so as an investor, what we are looking for is, are businesses that are going to take this particular round of money, meet certain milestones, and then increase your company valuation. And so then your next round, you're going to go out maybe not at 5 million, maybe it's at 10 million. And so maybe you go to a larger raise, maybe it's 2.5, maybe it's $3 million. So you're still giving up, maybe 25% of the business or 30% of the business, but it's a bigger pie. And so yes, you're diluting yourself, but your overall ownership, what that means, what early investors, what that means to them won't be nearly as severe as if you tried to raise, on a $5 million valuation, $3 million of funds. So, as we think about this, from an investor standpoint, increasing and stepping up that valuation is critical, and it really gives you as a business owner, your best possible chance for success in not only raising this round, but understanding what your future capital raises, are. So a little bit about, specifically what Innosphere Ventures does to support early stage companies, on their journey to raise capital. We'll quickly talk through this. But I would say that, as you think about potential partners in your journey, whether it's an incubator, an accelerator, hyper accelerator, or other VCs, you may want to be thinking about some of the same bullets that are here and the services that we would provide, right? So really understanding and talking a lot about what are those potential paths to obtaining funding. Providing research. So a lot of the data that you saw earlier, we will provide to our client companies. We'll go through and provide coaching practice on pitches, presentations, trying to get those tailored to whoever our client companies may go off and pitch for funding. We'll make introductions to investors as appropriate, and then certainly as the offers come in to the companies for funding, we'll help evaluate those. One thing that we will not do is provide any sort of fundraising, just because you have to be a certified broker-dealer here in the U.S. to be able to do that. And that's a line that we don't cross. You heard earlier, from Jim that these are some of the same things when you think about raising, and CSSI can certainly help you with that too. So transitioning a little bit to what are the types of investors, and how do you think about how you might want to interact with these folks as you go off and try to pitch them and actually raise money from them. So starting out here with angels. So this is the next step up on the layer beyond friends and family money. Is these angel investors, right? They're accredited investors as defined by the Securities and Exchange Commission here in the United States, and typically they'll do smaller rounds earlier on in the company, and a lot of higher risk associated with venture companies that are just kicking off. A lot of folks really target those. Hey, I've got a MVP product and I'm moving towards commercialization. When we think about med devices or pharma, et cetera, it's shifted a little bit if you're going off for a 510K. So you may not have, that clearance. So maybe there's a little bit, earlier investment, from angels as you build that and as you obtain the necessary stamps of approval. So in any case, right, one of the things, or some of the good things around angels, are that in most cases they will have come from the particular industry that maybe you're focused on. So I think about some of the angels here, particularly in Colorado, that will invest in med device companies. They all have a med device background. So what does that mean? That means that they have some expertise, they have some connections, and can be able to provide a lot of advice to early companies as they move that product forward. One of the things to keep in mind is that angel investors, there are some that will do direct investments by themselves, and the other way is through a group. So specifically here in Colorado, thinking about LIFESCIENCES, there's Rocky's Venture Club, who as a group does most of the deals, and then also Angel MD, which is a nationwide organization with a chapter here. One of the good things about groups such as this, they will syndicate, so that so not only will they invest from local money, but they will also make introductions to whether there are other angel groups or micro VCs, et cetera. So when you think about raising from an angel group, one of the first steps is to be able to get into the organization, and so a lot of these angel groups will have different technologies that they use to evaluate these the companies, whether it's Angel List or Seed Invest or Gust. It's that's their entrance point. So when you go and actually try to engage with them, most of them will say, hey, first thing you got to do is go ahead and submit your pitch deck, your pro forma, to these websites, and then they'll go through and actually screen that, using some sort of committee. So whoever in the group happens to be interested maybe in that sort of technology, they'll go through the screening efforts on literally thousands of companies that will apply for funding through angel groups. As an example, Rocky's Venture Club, which happens to be the oldest angel group in the U.S., continuously running, they'll see 2,000 to 3,000 different applications for funding come through in any year, and those get narrowed down to very quickly to 100 to 200 of potential investments. So 1 in 10 effectively, are screened out through the website. Then the screening committee will go off. They'll actually talk to them. There'll be some sort of pitch from the company, and you'll have a chance to engage with 2, 3, 4 members of the angel group. The idea is that, hey, they're going to go look at the deal and say, do we think that the broader group is going to have interest in making such an investment? And if so, they'll bring the company into the group and have a broader pitch with the organization. And then the best part is that once they have established enough interest, they'll become your lead investor. And we'll talk a little bit about the need for lead investor here later on and what that really means. But ultimately, they'll work with you to set the terms of the deal, and they'll actually conduct due diligence, and then go through and close the deal with you. So it is certainly a path, and it's a well-worn path for a lot of venture startups to go through. And these folks have some pretty well-defined processes that that you have the option to go through. So moving to the next level of the diagram is really around family offices. These are sometimes hard to tell between a family office and and maybe some what we might call a super angel. But ideally, a family office, is simply it's a wealth manager for a family that has a very high net worth. Some of these offices are not only aligned with a single family, but maybe they work with multiple families. But as you engage with family offices, you need to make sure of who you are talking to, because they will look at the deal a little differently. In a lot of cases, it's a challenge to meet with family offices. In general, you need to know somebody that will refer you to them. In many cases, these families will have made money in a certain market space, and so then they become very interested in and very knowledgeable around investing in that particular market. Not exclusively, but you may have better luck if you are finding a family office that has a particular interest, for instance, in med devices, and you're a med device company. In most cases, and a little bit different from an angel group, you're not going to find a family office that's going to go off and be a lead investor. So what they will do is, they'll essentially bring money to the table. But they will not actually do a lot of the diligence necessary to become a lead investor. So that's a little bit about family offices, and then so the next level up really is venture capital. This is probably the most well-known version of investors. Each venture capital firm will have an investment thesis associated with it. Right? How are we going to invest? Who are we going to invest in? What are the market spaces? What do we want our company portfolio companies to look like? and they'll engage with you, and they'll do the diligence necessary to become a lead investor. They'll also take a look at helping you syndicate the deal, raise additional money, not only in this round but potentially future rounds. We talk a lot about, hey, finding that right venture capital firm. What's the market space? Are they interested in the size of investment that you're looking for? When I think about some of these very large VC firms like a SoftBank, raising hundreds of billions of dollars, very unlikely that they would invest in a very early stage company just because it's not economical for them and it won't move the needle on their portfolio. Last one is the corporate and strategic venture. This is very highest level of the stack, and the idea is that some of these larger companies will have corporate venture arms tied to them. Sometimes they'll invest off the balance sheet, but in a lot of cases they will have a separate arm. And there's, from your standpoint, there's a lot of good things, and of course a lot of things that you need to be aware of. But where does that lead? Hey, you may have a built-in customer for your product, so that may be good. There may be some sort of joint development agreements that that they're interested in, and then ultimately, what's your exit strategy? You can read here a little bit about the staff. That really depends on how big a company is. I would argue that over the past few years, you see a lot of the corporate venture capital staffs growing, and so these large corporations, I think, are moving towards being able to put significant dollars in the marketplace. And in fact, in 2019, about 25% of the venture capital came from the corporate venture capital, or right directly off the corporate's balance sheet. And so we're going to wrap this discussion a little bit, around what are the areas where we see some challenges or some issues from the Innosphere standpoint. Something to be very aware of, and this is no different than other parts in life, is that it's going to take a long time to raise money. So going after that early and understanding what that process looks like is critical to be successful from your standpoint. We talked a lot about how investors look at the risk associated with a company. So you understanding your risks and being able to plug those gaps, and really thinking very long and hard about that is critical to being successful in this. There's a lot of questions that are going to come up from your investors, potential investors, around what's the market space look like. Again, they're looking at you as being experts, and if they're finding competitors that maybe you hadn't brought up or you don't have knowledge of, then it becomes a bit of a challenge around credibility of how well do you really know that market space. So the next few slides really are around the due diligence process. So we have a few here that just a little bit of a time check need to move through rather quickly. There's some 4 stages of investment here that we have listed. One would be your pitch material, so that's early on. Maybe that's how you generate the initial interest from your investors. The second one, really is around pitching to the partners, those folks that have screened you already and decided that, hey, this is interesting, and come on over and let's talk. Third one gets down to doing some due diligence, and then the fourth one is negotiating and closing through. So what is due diligence? The idea is that a investor will go through, look at their investment thesis, try to understand the risks associated with this particular investment, and does it meet what they think is going to be the reward. So you're going to go through, and investors are going to be looking at things around, hey, what is the problem you're trying to solve? How are you trying to solve that in some sort of unique way? What's the market size? what sort of traction do you have? Do you have any sort of competitive advantage in the market? Who is your competition? How are you going to make money? How are you going to exit? What are you going to do with the money that you raise? And what's the team that you have? And are you able to attract the talent that's necessary to actually be able to build the company and then return money back to your investors? So ultimately, it's digging in deep from an investor standpoint to understand your business. We talked, or I mentioned before, a little bit around lead investor and how critical they are. So a lot of what the lead investor will do is really run through that deep diligence with you as a company and put together an investment report. And so that then is able to be used by other potential investors. So a lot of times you're going to hear no to your pitch. A lot of times you'll also hear, hey, come back to me when you have a lead. And so finding that lead, especially at an early stage company that's willing to do that diligence, and is pretty critical, and sometimes very challenging. And then the other good thing about a lead is typically they'll go ahead and syndicate with other potential investors. So that's about the lead. Thinking about how does diligence actually work. Going into the from an investor standpoint, they're going to go through very detailed analysis of what what you're trying to do, what you're trying to accomplish, and they're going to go through it in in a very, what I consider to be, logical fashion. And so there's risks associated with that investment. They're going to try to get comfortable with those risks, and ask for a lot of information, detailed information from the company. So what are they going to ask? It's things simply beyond your pitch deck, but of detailed analysis of what your market size is, for instance. What sort of IP do you have? What's your pro forma? What 5 years from now? What does your cash flow look like? Cap table, that's a big deal. So understanding not only what money you raised previously, but what sort of outstanding obligations you have, either through safes or notes, etc. So I'm not going to go through all of these, but you can see here it gets pretty detailed, around what people are going to ask for from an investment standpoint. And again, this is all towards understanding your business and understanding the risks around your business. So, so one of the best practices is really to have a data room ready with all of that information, in it, so that as an investor asks for certain things, hey, you can point them to your data room, you can provide that to them, you can provide them up to date information. As with anything in life, a single point of contact is a best practice, so that both sides know what's going on. In a lot of cases, you're going to get the same questions from multiple investors. So, as you answer those questions, having that available for your next set of investors, I think is smart and will save you, a lot of time. Touching on what are the best practices here in more of a COVID-19 type environment where maybe, you're not meeting face to face. I would say that we have a partner in Israel, and she is meeting folks face to face right now. Who knows how long that'll last. But ultimately, there are a lot of things that you can do remotely, and whether it's your product demos, whether it's you're going through your pro formas with the potential investors. They're going to do customer research, so providing names for potential people for them to reach out to. They can do that remotely. But I'm gonna slow down here just for a second, because very early on, in a lot of angel investors, they're investing in people, and so they really want to look company founders, company owners in the eyes and make that investment. So it remains to be seen how adversely that's going to affect investments going forward, especially at the angel and seed stage. So ultimately, right, from an investor standpoint, we're looking for companies to convince us of, certain things, right? Can you make money? Can you win in the marketplace? And does the terms or the valuation of your company, is that real? Does it fit into, what the market is saying a valuation is, based on the milestones you've achieved, etc. One of the big things, not only in startup world, but of course corporate world, is around execution. And do we believe that the team can, execute and grow this company, and then ultimately exit to return, money not only to the venture capitalists, but also to all the partners, right, that have put their money into the into our fund. So got to convince not only the partners in the fund, general partners, but also the limited partners are very interested in your success here. So what do we mean about hey, can money be made? You're going to hear a lot of times around, hey, is your target market big enough, right? Because a lot of times the people are talking about billion-dollar markets, right? That's ultimately a lot of folks that are looking for big money to be made. That's the market size that they're talking about. Now, what we see a lot from folks is, hey, all I need to do is get 1% of the really big market, and we'll all be good. And that's fine, but we always follow up with the question of, well, how do you get to that 1%? What's your customer acquisition process? Because, yeah, philosophically, 1% is great, but getting back to execution, that's the real question, right? Is how do you actually get to that revenue that you're projecting, and that percentage of the market. Talking a little bit about the execution. How do we diligence things like this? We're going to do a lot of reference checks, resumes. We'll talk to you from a technical standpoint. We're going to have technical experts look at your whatever your product or service happens to be, and then also working with you to understand what your hiring plan is, and do you have a good organizational chart and an understanding of what gaps you need to fill. So there's a couple more slides here that we've already talked about. So I'm going to finish up with again, some of the best practices, lessons learned, some of the issues that we see from an investor standpoint around trying to engage with early stage companies. One of the biggest challenges is understanding what the valuation is for an early stage company. That in and of itself is very difficult. And if it's your first time through, then understanding what the models are, what are the different techniques, is probably something you want to take a look at, so that when you go through and set a valuation, it's not outside the norm. Of course, the farther outside, the more difficult questions you're going to get. We see a lot of folks that come in with cap tables that have founders maybe that have moved on, maybe they're not active in the company, whatever that happens to be, but it's really adversely affecting the folks that are currently operating the company, and so maybe they're not incentivized as much as maybe they think. So really understanding what your capital strategy is pretty critical here. We're talking about, hey, is the market large enough? A lot of times what we see people come in, for instance, we've got folks that will come in with maybe 3D printing and say, yeah, hey, 3D printing is $25 billion market, growing at a 9%, 12% CAGR. But then we start digging in, we really understand, hey, you're only addressing a slice of that market. So those are the conversations that you're going to get into. And that is a wrap for me. Going through a little bit on the broad background of some data associated with the market looks like, different types of those investors that you see, and a little bit about the diligence. So I don't see any questions on the Q&A session, but Zan, do you see any? Or
Yeah, really appreciate you going through. Big thanks to Tim for this info, because it's yeah, really useful to get the breakdown right from the types of investors, what they want to see, to the issues in the process. And so yeah, I'll give folks a quick minute here just to put in any questions. As far as kind of following up from this, yeah, we've got our future topics. We'll send out a follow-up, and we even have a survey you can vote on the kind of topics that could be upcoming. And yeah, kind of building on this with the investment, right? We've got more deep dives into early stage financing, right? More tips and tricks for it, more kind of understanding the market sizing and forecasting. Yeah, and then also, going back also to the regulation side, looking more at the artificial intelligence, machine learning regulations with the FDA. So I think, yeah, there's more topics to come. Definitely vote on the ones that you want to see. And then let's see. Yeah, I think maybe just do a quick question here, kind of around the COVID topic. I think one that we get a lot, right? Kind of we all see the kind of basic impacts of COVID, right? You can't meet folks in person, such like that. Is there anything that you think startups should be doing actively differently, either in their pitch or in their approach because of it?
yeah, so I'll take a look at it from both sides. One is current market conditions. We talked a little bit about COVID-19. So expectation is that valuations will decrease. A lot of folks are saying between 20 and 30%. You may see or may have interest in tranching investments. So maybe staggering those. With a smaller and then a follow on once you've hit the milestones. So that's a potential strategy for folks that are trying, being very sensitive to some of the other terms of the deal, whether or not they're interested in cumulative dividends, for instance, or non-participating of preferred stock. So understanding when folks are asking, hey, I want a 2x liquidation preference, what does that mean, and how does that affect your cap table? And so it's really around, a lot of the pitch was, risk and trying to mitigate that risk. And so what you're going to see is, I think, a lot of investors that are in this very turbulent time trying to, put a floor on their risk. And so, you as a company, if you're coming in with terms that maybe are more favorable to the investors, you might be a little more successful.
Right. No, that's perfect. And yeah, I think we're coming right up to the time here. I don't know, Jim, if you want to give any quick words on, I think we got here just write a kind of contact line for the program.
Yeah, no, thank you, Zan, and thank you, Tim, so much for the presentation today. We welcome your comments. We welcome your suggestions for additional programming as we move forward. And if you have additional questions, please use the FDA help desk that we've established, and we'll answer your questions within 24 hours. So thank you for your participation, and we look forward to future educational programming. Zan?
Perfect. Yep. Thank you all for being here. And yeah, we'll be in touch with the next one soon. And hope you'll have a great one. Take care, everybody.